Every year, once the banks report in, HMRC starts sending letters and quietly changing tax codes because of people's savings. Not investments, not side hustles, ordinary savings accounts. And if one of those letters lands on your doormat, here's the one thing to know before you accept the number printed on it. HMRC's own savings figure is, in the words of tax charity LITRG, not always correct. Joint accounts counted wrong, tax-free ISA interest included by mistake, whole years mixed up. So no, don't panic, but don't ignore it either. There's usually a deadline in that letter, and it matters. Okay, so in the next 5 minutes, how the taxman already knows what your savings earn, the 3 traps catching ordinary savers, and how much interest you can earn before tax touches a penny of it. Because there's a headline number floating around, 18.5 grand of interest, completely tax-free. It's real, but only works if you have almost no other income. Your real number, probably a lot smaller, and in the next few minutes you'll find out. Let's put it under the microscope. First, how is savings interest actually taxed? Because it's nothing like most people think. Your interest is paid gross, which is no tax taken off. Then it can pass through up to 3 tax-free layers. Layer 1, your personal allowance. 12.5 grand or near enough. If your wages or pension don't use it all, the spare part can soak up interest. Layer 2, the starting rate for savings. Up to £5,000 of interest at 0%, but every pound of other income above 12,570 eats a pound of it. Once your other income reaches 17,570, gone. Layer 3, the Personal Savings Allowance. £1,000 a year if you're a basic rate taxpayer, 500 at a higher rate, and 0 at additional rate. Stack all 3, someone with almost no other income can earn 18.5 grand in interest, completely tax-free. But here's the bit the headlines skip. Normal salary, layers 1 and 2 are already used up by your wages. Your real allowances is the last layer, £1,000 or 500. And to give you a feel for it, at say 4.5%, roughly 22 grand in savings makes about £1,000 of interest a year, enough to break through it. So, how does HMRC know what your savings earn? Simple, your bank tells them. Every year, once the tax year ends, banks and building societies report the interest they paid you straight to HMRC, usually by the 30th of June. You send nothing, it's automatic. HMRC takes that data and for the most employed people adjusts your tax code, so the tax just drips out of your payslip. Or they post you a calculation, a P800, or something called a simple assessment. But there are 2 catches. If your savings and investment income tops 10 grand, you're into self-assessment, a full tax return. And if you know you've gone over your allowance and HMRC hasn't written to you by the 31st of March after the tax year, officially it's on you to contact them. So the system is automatic, right up until it isn't. And that's exactly where the traps live. Guys, just a quick interruption. If this is already clearer than your bank's ever made it, please hit the like button and give us a subscribe to receive notifications each time we release a video. Let's get back to it. Trap 1, the cliff. Cross into higher rate tax, even by a single pound, and your savings allowance instantly halves. £1,000 becomes £500. Picture it, you're on £49,270 with £1,000 of savings interest. A £1 pay rise tips you over, and under this year's rules it creates about £100 of extra tax. £1 in, £100 out. Now, the timing bomb. Multi-year fixed rate bonds. If your bond only hands over the interest at maturity, the whole lot can count as income in one single tax year. 3 years of interest dumped into 1 year. Straight through your tax-free allowance, maybe even pushing part of your total income into a higher rate tax. And whether that happens depends entirely on your account's terms, on when the interest is actually made available to you. Some bonds credit it yearly and let you access it. Some lock it to the very end. Same headline rate, but potentially a very different tax bill, arriving at a very different time. So check the terms before you fix, and check them again before you believe HMRC's version of events. Which brings us to trap 3, the number itself. Duplicated figures. An ISA interest that should never be there. Joint accounts split wrong. Old estimates rolled forward. The tax you owe is based on what you actually earned, not on whatever number landed in the system. If HMRC writes to you about savings interest, here's your 5-step check. 1. Get the real numbers. Ask every bank for a certificate of interest for that tax year or pull it from the app. 2. Strip out anything in an ISA and premium bond prizes tax-free. They should never be in the figure. 3. A joint account? Normally that interest splits 50-50 between you. 4. Compare your total with HMRC's. If theirs is wrong, contact them with the correct figures. They'll fix it. 5. Mind the deadline in the letter. Query it. Don't shelve it. And one more thing. From April 2027, the tax rates on savings interests go up. 20% becomes 22, 40 becomes 42, and 45 becomes 47. Same tax-free layers, higher rates on everything above them. Getting this right is about to be worth even more. So, quick recap under the microscope. Your bank reports your interest automatically. Your real tax-free allowance is probably £1,000 or $500. The 18.5 grand headline only works with almost no other income, and the letter isn't a fine, but the figure is not always correct, so check it before you accept it. One last thing, your savings account isn't the only thing being reported to HMRC. If you started investing on any of the apps, there's a whole different set of traps waiting there. That video's next. Subscribe so you don't miss it. See you on the next one.